please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Largely steady at the index level. Prakash Industry Q4 numbers on your screen. Revenues up 33%. Let's invite Sandeep Wagle and Kiran Jadhav on the show now. Sandeep, your thoughts on the Nifty trade so far and any individual trading ideas that you would recommend?
Afternoon, Rima. I would be bullish on the Nifty. I would look at 10,800, 820 being tested maybe today, maybe on Wednesday. Until we stay above 10,700, I don't see any kind of weakness. So I would remain long or buy on declines will be my view. Stock specific, I would go with a buy in a Yes Bank that is about to give a breakout. I'm preempting that. Buy it with a stop loss of 357, target of 378. And sell a Canfin Homes that is showing weakness. Sell it with a stop loss of 432, target of 400.
Okay, all right. Then just keep an eye out on Prakash Industries. Those numbers look very, very good. I remember the management guiding for strong Q4, and that's precisely what they have delivered. So those numbers look good. We'll get chatting with the management in the next 10 minutes odd. But coming across to Kiran then. Kiran, your take on the Nifty, and if you could give us your trading calls for today.
Yeah, very much the same as Sandeep's view. The market is looking pretty good, and we have a trailing stop loss now placed at around 10,720 for a target of 10,860 odd levels. For stock-specific ideas, I've got three ideas. First is Tata Chem. Tata Chem is looking very good on the charts. It has given a breakout of a consolidation, and it has broken the swing high as well. On the derivative front, it has gathered a good kind of momentum with 3% additions in open interest. At the same time, the option chain data is also very strong. The 780 and the 800 call option are attracting a lot of activity, which tells us that positionally we are going to move towards 800. However, for today, we have a stop loss at 755 for a target of 780, and which could be trailed for a target of 800 in the days to come. Second would be Siemens. Siemens also looks good on the charts. It has been following ABB, which has moved up pretty well. And here the next resistance as such is around the 1130, 1145 mark, which should be the targets. Open interest additions to an extent of 6% has been seen. Stop loss suggested over here is 1104. Third is L&T Finance, where we believe that this is one counter that should be looked at with a trading as well as a moment positional that should be looked at with a trading as well as a moment positional kind of view. Stop loss very near to the current price, which is at around 170. Target of 177 for today, but with the positional view, we will have a target of around 185, 187.
Okay. Gentlemen, thank you very much for your time this afternoon. Prakash Industry continues to hold up, gains of 4.5% on the back of strong numbers. Revenue growth 34%, margins improving by 160 basis points to 180 basis points to 15.7%, and a multi-fold jump in the company's profitability. But the stock which is right now on our radar is Shoppers Stop. While there was a decline in revenues fell by nearly 7% on a year-on-year basis. Operationally, the numbers were better than what the street was anticipating, and the reduction in debt has boosted the company's profitability. Govind Srikhande, the MD of the company, joins in now. First, Mr. Srikhande, if I may start with the decline in revenues, down 7% in the March quarter. The key reasons, and when do you see revenue growth improving?
So one issue that you'll see during the quarter is we had preponed our sale this time around in Q3 by about 7 days, and during Q4 we actually curtailed the sale by about 10 days. So both these combined, you will see an impact on the like-to-like growth. We are also seeing the continuing impact of the renovation of certain stores and renovation of certain malls that have been undergoing customer entry challenges, sales challenges. That still continues, and that will recover from Q2 onwards in the coming financial year. But I think our focus in the last 2 quarters has been on the financial restructuring, and we believe that we have been able to pull it off pretty well.
Well, so on a like-to-like basis, growth in FY19 should be what? Around 7 after around 8%, as you'd guided earlier?
So Q4 was actually a decline of 4% in like-to-like growth. And as I mentioned, the factors were related to sale preponement as well as the renovation undertaken in multiple stores and malls. Going ahead, we believe the next year should be quite okay, and we are targeting a 7.5% like-to-like growth throughout the year. Although Q1 could be slightly slower because Q1 last year was a very high growth of 18% because of GST. GST that was brought in July had a huge impact on sale in June because the sale was preponed. So other than Q1, we believe through the year we should be ending at 7.5%. Q1 should be slow.
Okay, Q1 should be slow, but things should pick up and end FY19 with a 7.5% growth. You've paid debt much faster than the 300 crores that you had earlier guided. You also said that the company will be debt-free by Q3 FY19. Would you look to prepone that guidance?
I don't want to change the projection right now. We believe, yes, for the full financial year, we should be debt-free. Whether it happens in Q3 or Q4 depends on the sales number, really. But if you look at fundamentally, we have been able to reduce almost 500 crores of debt in the last year. And as a result, our net debt today position is only 67 crore. So that position is very, very good. And it has a direct bearing on the way the profitability changes and also the exit out of multiple JVs and subsidiaries. That is also impacting the profitability at an overall level.
Well, sir, so double-digit revenue growth in FY19, that's on the cards?
Yes, likely, because we are also targeting to open about 5 new stores.
Okay, and on margins, what kind of improvement can the company deliver?
So we believe that we should grow the margin by about 100 basis points during the whole year.
Well, in the longer term, can your margins touch double digits, say in the next, 4-5 years?
Maybe shorter than that, because we believe we should be able to gain 100 basis points for the next 2 to 3 years. So we should be able to hit about 8% before 2020 at EBITDA level.
Okay. If you could tell us what's the issue with private labels, because their contribution to revenue hasn't improved as was earlier projected.
So private labels, we have struggled during the last whole year, including Q4 as well, and we believe the struggle will change into positive momentum starting second half of this year. We have taken up a whole cleanup of private brands, so you'll also see a lot of discounting that we have done in this quarter, which has also led to drop in margins as well. But we believe it's the right thing to do for future, and Q2 onwards we should start seeing the traction up, but second half definitely we should be back on a track of 9.5% plus share of private brand. Definitely the long-term target would be between the 12 to 15% over the next 3 years period. This quarter we were below 9%.
Well, sir, so what new brands can the street expect tie up with? In fact, your new CEO has handled brands like Burberry and various other Brooks Brothers, etc. in the past. Anything from the luxury space that's on the cards?
These are all luxury brands, so not very easy to get them, and some of them are already in India, and they do operate generally through standalone stores, not generally in shops. But yes, we will make an effort in trying to bring in new brands into the store, and yes, that effort is on right now.
Okay. Thank you very much, Mr. Srikhande. That's the word coming in on Shoppers Stop. Stock is down close to about 1.5% as the revenue growth in Q4 disappointed the street with a cut of close to about 7%. But the commentary from the management was positive about things improving, ending the year with a 7.5% revenue growth. That's the reason why the stock is recovering from the day's low. Let's get in the early rates from the European market. Asia's had light trading on account of a few markets shut, but the ones which were trading like Hang Seng had a very good session with gains of about 450 points. Europe has opened up absolutely flat. The CAC is down, the FTSE is up, the DAX is higher by close to about 0.25%. So not much movement at least.
In Prakash Industries, that's the stock that's in focus. Remember, it's posted a rather good set of numbers, and in fact, the stock was holding higher in today's trading session. Let's see what it's doing currently. It was up close to around 5%. It went past the 230-hour mark, and it's come off a tad bit because in the last few trading sessions, the stock has had a bit of a run. So you pull up maybe the last week or 2 weeks, you'll see that the stock has moved from around the 205 to around 225. So the market was expecting good set of numbers, and they've delivered a pretty good set of numbers. But to understand what's the outlook going ahead, we have with us Mr. Ved Prakash Agarwal, Chairman of Prakash Industries, who joins us. Hi, Mr. Agarwal. Congratulations, sir. The numbers look quite good. So things are looking up, as you told us in the third quarter. Just one thing, sir. You had told us at the end of quarter 3 that the numbers will look good. So they're looking good, but margins you guided for was around 25%. Our calculations tell us that the margins have come in lower than that. If you could help us out with why did that happen, and going ahead, what kind of sustained margin should you do?
Yeah, the results are very good. And in the last quarter, the average realization, the EBITDA margin was 21%, and this time 23.5% is the EBITDA margin. It is because from the last quarter we had the orders which were carried forward to this quarter, so the prices, the sales prices get averaged out. So therefore it was 23.5. Although during this quarter the margin from the fresh orders was 25%. So we can say that in the current quarter, the opening is at 25%, so we should be comfortable in this on an average basis.
Okay, Mr. Agarwal, just to clarify to our viewers, the manner in which you are calculating the operating profit is a little different from the way we are calculating it. So as per us, the margins are lower than the 21-23% that you're talking about. But you're saying going ahead, you're looking at 25%, so we'll take your word for that.
Okay, as per the company's calculation, as you'd earlier guided, FY18 revenues hit the 3,000 crore mark. What is your guidance in terms of revenues for FY19 and the kind of volume growth you expect?
Yeah, FY19 is going very well, and we have a guidance of 60% growth in this year, and with a turnover target around 4,700 crores.
Okay, and what will that all be volume growth?
The volume growth would be about 60%.
Okay.
Of course, volume would be about 45%.
45%.
Yeah.
So you're expecting prices to go up by around 15% in comparison to the average of FY18, right?
That's true. That's true. Yeah.
Okay. All right. Sir, if you could help us out with, what exactly were the sales volumes in the last year, and in the coming year, what would it be, the absolute number, sir?
The sales volume growth last year was about 25%, and that was about 0.8 million. And in the following year, it is likely to be 1.2 million.
Okay.
Okay. You recently got a CARE upgrade. Your finance cost as of FY17 was about 86 crore. What's your guidance in terms of finance costs for the coming year? How much will it be lower by?
The finance cost has been pretty good in the sense that our loans have gone down. So the finance cost in the following year would be much less by about 10%.
By 10%. All right. So you're saying that it will come down to around 78 crores from around 86 crores, sir?
Yeah, something like that.
Okay. Mr. Agarwal, your FY18 has been good. You can't really question you on that. You're sounding confident as well in terms of FY19. You're saying that you paid back some loan, right, in the past quarter. But your finance cost, sir, for the past quarter is at around 25 crores. Now, that compares with around 21 crores on a year-on-year basis. And on a sequential basis, that 25 crores compares with around 19 crores. If you repaid your loan, sir, then in fact, the interest cost should have come down, right? Or is it on the count of working capital? Just clarify that for us.
Yeah, it is because that the overall loan last year was on the 31st March was 950 crores, which has come down to around 800 crores as on date. And the interest cost is showing higher because in the meantime, we have paid for FCCB the interest, which now stands converted into equity.
Okay, FCCB interest you have paid out there. So on a sustained basis, you're saying that this interest cost will be much lower than the 25 crores per quarter. It will be around 18-19 crores.
Yeah, it should work out to that level. Yeah.
18-19 crores, right?
Yes, yes.
Okay. All right. Mr. Agarwal, thank you very much for joining in. So that's Prakash Industries. Bringing in more trade safeguards in the agricultural space is the need of the hour. That's the word coming in from Rajiv Kumar, the Vice Chairman of Niti Aayog. Speaking to CNBC TV 18's Yash Jain, Rajiv Kumar said that the government is confident of achieving 75% in the current 7.5% in the current financial year and accelerated to double-digit by 2022. Listen in.
We will do 7.5% this year, despite whatever you say. And already IMF and the World Bank, etc., are saying 7.4, 7.2. I think it's be 7.5 and above. 3, credit growth has actually increased. It's now 12.5% rather than 4% and negative, which was one year ago, and that's the best thing. 4th, capacity utilization figures are at 74% for the first time after, I think, about 26 or 28 months. So, and as soon as capacity utilization rises to these sorts of levels, we begin to expect new investment. Right. And 5, in many manufacturing sectors, you've had more than double-digit growth, which are the heavy and medium trucks, autos, cars, tractors, cement, steel. All of them are beginning to click now and truck. And finally, let me say that because of the government's affordable housing program, you've got builders now coming into this in a big way. And the real estate sector is moving again, not the middle class private sector, where there is a lot of inventory, but even there, we in Nifty are trying to resolve that. So, and finally, you've got a good monsoon forecast. So why wouldn't you expect higher growth rate? And for the 2022, I say this on the basis of the huge amount of work, the foundational work that this government has done, which is GST, which is insolvency, which is Benami, which is all sorts. I've got a list here. Right. I've got a whole list of structural reforms. These are the ones who will now begin to yield fruit in the next few years, and that's why we'll go up to double digits.
It's a couple of IT stocks that are doing well, so I think we should pull up the intraday chart of Saxoft. That stock, in fact, has spiked up to the high point of the day, so keep an eye out on that one. But as promised, we're shifting focus to the commodity space. Manisha Gupta is with us. Manisha, what's going on there?
Well, some sweetness into your life, really, because sugar prices have seen some stability come in the global markets as well. They have seen some support. Remember, sugar actually has been the biggest underperformer, not just the previous year, but much of this year as well. But with the latest trends coming in from Brazil, that clearly has been supportive there. Now, Brazil says that they are moving from sugar to ethanol for the hope of better returns, because sugar clearly has been down in the dumps. So with that, with the kind of movement that they are making here, 6 million tons of less sugar is what they are looking to produce. So that brings us to export surplus from Brazil going down to up to 22 million tons for this current year. And that number really translates to the fact that the Brazil global sugar market share will fall from 52% to around 35%. And that's a big bump up for the Indian sugar prices and the stocks here as well, because remember, the sugar industry in India has a mandate of exporting 2 million tons, and with the kind of sugar prices in the international markets that we have been looking at, it has been a loss for the Indian sugar markets, not just in India but in the global markets as well. But with this latest move coming in from Brazil, there is hope for the Indian sugar exports as well, and that clearly comes to be as a supportive. Remember, we are looking at Indian sugar output at a record high of around 30 million plus, and that of course has been pulling the prices on the lower side, so much so that Indian sugar prices have been trading below cost of production. Not just India, we are looking at higher sugar or a bumper crop this time around from other countries like Thailand, European Union, etc. But with this decision coming in from Brazil, it clearly has started as a stronger week when it comes to sugar prices.
Okay. Thank you very much for that, Manisha. With that, it's a wrap on Halftime Report. But the next 3 hours are going to be very crucial. You've got big earnings coming up from the likes of HDFC Limited as well as Kotak Mahindra Bank. As we get into a break and wrap the show, let's get you some market opinion from S. Krishnakumar, the CIO of Equity Sundaram Mutual, on how the earnings season has panned out so far and the sectors he likes.
The earnings season has done extremely well in the first month. We've had a lot more positive takeaways from the results, and except the usual suspects, the corporate lenders, we have seen otherwise a very nice and rising earnings trajectory across various sectors in the economy, with double-digit earnings growth into the next 24 months. So this is where I think fundamentally the market looks good from a medium to long-term perspective. However, some of these macro things we mentioned and the election issues could again move the other way and create some volatility in the next 15 to 30 days, which is something which we can't rule out.